In 2026, the average monthly payment on a new 30-year mortgage in the U.S. is often 50 to 60% higher than it was in 2021 for the same loan amount. Not because the homes doubled in price, because the cost of money did. In 2021, buyers were locking in 30-year fixed rates near the all-time low, roughly 3% or even less. By 2022 to 2023, those same loans were offered at 6 to 7% and briefly even higher. And in early 2026, 30-year fixed mortgages are still hovering around the low 6% range, roughly double those pandemic lows. At the same time, more than half of all outstanding U.S. mortgages have rates below 4%. Millions of homeowners are literally locked into ultra-cheap debt. They are not eager to give that up. So in 2026, the housing market did not crash. It froze. Prices didn't collapse. They didn't surge either. They stalled. And millions of people are still waiting for rates to drop, waiting for prices to fall, waiting for normal. But here's the problem. The system has already adjusted. And if you still waiting, you losing in ways you don't see. Today we break down asterisk what actually happened in 2025 to 2026 asterisk. Why prices didn't crash asterisk, why affordability is worse than headlines suggest asterisk. Why just wait might be the most expensive financial decision of this decade. Let's deal with facts. 1. Interest rates in 2022 to 2023. Mortgage rates in the U.S. spiked above 7%, the fastest jump from record lows in modern housing history. In 2024, they fluctuated mostly between 6% and 7%. High by post-2010 standards, but not 1980s level crazy. In 2025, they modestly eased, but stayed historically elevated relative to the 2010 to 2021 decade, when 3 to 4% felt normal. Here's where it gets dangerous. Even though prices aren't exploding, affordability is worse than in 2021. Let's break it down. Example, asterisk home price in $2,021,400,000 rate, 3% monthly payment, $1,686 principal plus interest asterisk same. Home in 2026, $420,000 rate, 6.5% monthly payment approximately equals $2,654. That has nearly $1,000 more per month, not because the home doubled. Affordability depends on the payment, not the price alone. And wages did not double. So you get this asterisk, the price chart looks not that bad, asterisk, the buyer's monthly budget feels completely wrecked. That gap between how the chart looks and how the payment feels is the affordability paradox. So why do people still believe a crash is coming? 3 psychological anchors. 1. 2008 trauma, the last big housing story burned into people. Sprains is 2008. Asterisk. Prices went up too fast. Asterisk, then they collapsed. Asterisk, people who waited got deals. So the brain builds a rule. If prices go up fast, they have to crash. But today's structure is different. Asterisk lending. Asterisk lending standards are far stricter than pre-2008. Asterisk underwriting is tighter. Credit availability has been shrinking, and lenders demand higher scores and better documentation. Asterisk, the share of risky exotic loans is far lower too. Prices went up to fast logic emotionally. It feels right. This can't be sustainable. It went up too fast. Has to come down. But markets don't owe you emotional symmetry. Sometimes prices. Asterisk spike asterisk then move sideways for years. Asterisks while wages, rents, and inflation slowly grind higher underneath on paper. In reality, it's a slow, grinding shift in who can still get in. 3. Media incentives. Media runs on attention. Bad news generates clicks. Market stabilizes and boring gridlock doesn't. So the loudest narratives are asterisk, crash coming, asterisk, 30% downside asterisk, this is 2008 all over again, but look at fundamentals. Asterisk. Lending standards remain strict asterisk. Homeowners have record equity buffers. Total home equity is at or near all-time highs asterisk. Unemployment has risen from the absolute lows but hasn't spiked into crisis territory. It's closer to 4 to 4.5%, not 10% plus, no forced selling wave. No structural panic, just gridlock. The real risk is not a spectacular crash. The The real risk is stagnation. Here's what that means. If prices stay flat for 3 to 5 years, but rents keep rising and rates remain elevated, renters bleed slowly. Homeowners with low rates win by default. First-time buyers stay trapped. This is a slow transfer cycle, not a crash, a freeze. In a freeze, asterisk their S, number 30% everything on sale moment, asterisk their S, no mass. Foreclosure wave, asterisk their S, just a quiet widening of the gap between people inside the system and people outside it. Every year you rent in that environment, you're paying someone else's mortgage. While the option to fix your own housing costs drifts a little further away, who actually benefits from the 2026 housing freeze? Banks' steady margins. They're not enjoying the refi boom of 2020 to 2021, but higher base rates mean healthier interest margins than the ultra-low rate decade. Builders limited but stable supply. In a world of underbuilding and tight resale inventory, good projects still find buyers, often without needing deep discounts. Owners locked below 4% massive advantage. They hold a structural edge. Asterisk their cost of money is far below today. Asterisk their payment is fixed. Asterisk inflation works in their favor. Year after year, who loses? The ones waiting for normal, because normal was an anomaly. 3% mortgages were a historical distortion, not the baseline. The biggest housing lie of 2026 is this: just wait. It will crash. Maybe, but what if it doesn't? What if this is the new structure? You don't have to buy. But you cannot afford blind waiting. Waiting without numbers. Waiting without a plan. Waiting because a thumbnail told you salvation is one crash away. Because the system doesn't pause for hope. It adapts. Rates reset. Policies shift. Builders adjust. Investors reposition. And if you don't understand the structure, you become the margin. So the real question isn't, will it crash? The real question is, what happens to me if it doesn't?